You know, I always look at IQ and talent as sort of representing the horsepower of the motor, but then in terms of the output, the efficiency with which the motor works, that depends on rationality, because a lot of people start out with 400 horsepower motors and get 100 horsepower of output, and it's way better to have a 200 horsepower motor and get it all into output. And so why do smart people do things that interfere with really getting the output they're entitled to? And it gets into habits, into character, into temperament, and it really gets into behaving in a rational manner. It's not getting in your own way. As I say, everybody here has the ability absolutely to do anything I do and much beyond. And some of you will and some of you won't. But it will, the ones that won't, it will be because you get in your own way. It won't because the world doesn't allow you to. It will be because you don't allow yourself to. Well, in 1973, the Washington Post company had gone public in 1971, right about the Pentagon Papers time. But in 73, the Nixon administration was, through B.B. Rebozo, who was a pal of Nixon's, they were challenging the licenses of 2 of the Florida television stations the Post owned. So the stock went from 37 down to 16. Now, at 16, there were about 5 million shares outstanding. So the whole Washington Post company was selling for $80 million. And that included the newspaper, 4 big TV stations, Newsweek, you know, and some other assets, and no debt to speak of. So the Washington Post company, which was intrinsically worth $400 or $500 million, was selling for about 80 million in the market. We bought most of our stock at about the equivalent of 100 million in the market. And it was ridiculous. I mean, you had a business that unquestionably was worth 4 or 5 times what it was selling for. And Nixon wasn't going to put them out of business.
When you're doing these analyses then and now, do you have computers that help you, or how did you actually read all? Did you just get printed materials, or how did you, in those days, get the materials to read about the Washington Post? And how do you do it today?
Well, pretty much the same way, except there's fewer opportunities now. But I met Bob Woodward back, and he'd just come out with all the president's men, and all of a sudden, as below 30 years of age, he was getting quite wealthy, and we had breakfast or lunch over at the Madison Hotel. And he said, "What do I do with this money?" And I said, investing is just about assigning yourself the right story. I said, imagine Ben Bradley this morning said to you, what is the Washington Post company worth? What would you do? You have to write the story in a month. You'd go out and interview TV brokers and newspaper brokers and the owners, and you'd try and value each asset. I said, that's what I do. I assign myself the right story. And it's nothing more than that. Now, there's some stories I can't write. If you ask me to write a story on, what is some glamorous but non-profit making business worth, I don't know how to write that story. But if you ask me to write a story on what is Potomac Electric Power worth or something like that, I can write the story. And that's what I'm doing every day. I'm assigning myself a story, and then I go out. Generally speaking, investing in yourself is the best thing you can do. Anything that improves your own talents. Like, nobody can take it away from you. They can run up huge deficits, and the dollar can become worth far less. You can have all kinds of things happen. But if you've got talent yourself, and you've maximized your talent, you've got a terrific asset. And so that doesn't mean everybody should go to college, but it does mean that any way you find to improve, communication skills are enormously important. I mean, I took a Dale Carnegie course that I paid $100 for, and it was worth a college degree. At least I thought it was. Maybe this interview will convince people otherwise. I have an old-fashioned belief that I should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know, in general, what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. Evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business. So figuring out the economic consequences, TV, I think there's, 20, 25 million sets a year sold in the United States.
I don't think there's one of them made in the United States anymore. I mean, you'd say TV set manufacturer, what a wonderful business. I mean, everybody, now nobody had a TV in 1950, or thereabouts, 45 to 50. Everybody has multiple sets now, but nobody in the United States has made any real money making the sets. They're all out of business. You know, the Magnavoxes, the RCAs, all of those companies. Radio was the equivalent of the 20. Over 500 companies making radios in the 1920s. Again, I don't think there's a U.S. radio manufacturer at the present time. But Coca-Cola, you know, what was it, 1884 at Jacob's Pharmacy or whatever, the fellow comes up with something. A lot of copiers over the years. But now you've got a company that is selling roughly 1.1 billion 8-ounce servings of its product, not all Coke, Sprite, and some others, daily throughout the world 117 years later. So understanding the economic characteristics of a business is different than predicting the fact that an industry is going to do wonderfully. And so when I look at the internet businesses, or I look at tech businesses, I say this is a marvelous thing, and I love to play around on the computer, and now I order my books from Amazon and all kinds of things, but I don't know who's going to win. Unless I know who's going to win, I'm not interested in investing. I'll just play around on the computer. And defining your circle of competence is the most important aspect of investing. It's not how important, how large your circle is. You don't have to be an expert on everything. But knowing where the perimeter of that circle of what you know and what you don't know is, and staying inside of it, is all important. Tom Watson Sr., who started IBM, said in his book, he said, "I'm no genius," he said, "but I'm smart in spots, and I stay around those spots." And you know, that is the key. So if I understand a few things, and I stick in that arena, I'll do okay. And if I don't understand something, but I get all excited about it because my neighbors are talking about it, the stocks are going up and everything, I start fooling around someplace else, eventually I'll get creamed, and I should.
The whole long-term capital management, and I hope most of you are familiar with it, but the whole story is really fascinating, because if you take John Meriwether and Eric Rosenfeld, Larry Hillenbrand, Greg Hawkins, Victor Agani, the 2 Nobel Prize winners, Merton and Scholes, if you take the 16 of them, they probably have as high an average IQ as any 16 people working together in one business in the country, including at Microsoft or wherever you want to name. So there's an incredible amount of intellect in that room. Now you combine that with the fact that those 16 had extensive experience in the field they were operating. I mean, this was not a bunch of guys who had made their money, you know, selling men's clothing and then all of a sudden went into the securities business or anything. They'd had in aggregate, the 16 had probably had 350 or 400 years of experience doing exactly what they were doing. And then you throw in the third factor, that most of them had virtually all of their very substantial net worths in the business. So they had their own money up, hundreds and hundreds of millions of dollars of their own money up, super high intellect, working in a field they knew, and essentially they went broke. And that to me is absolutely fascinating. I mean, if I ever write a book, it's going to be called Why Smart People Do Dumb Things. My partner says it should be autobiographical, but But this might be an interesting illustration, and these are perfectly decent guys. I respect them, and they helped me out when I had problems with Solomon, and so they're not bad people at all. But to make money they didn't have and didn't need, they risked what they did have and did need, and that's foolish. That is just plain foolish. It doesn't make any difference what your IQ is. If you risk something that is important to you for something that is unimportant to you, it just does not make any sense. I don't care whether the odds are 100 to 1 that you succeed or 1,000 to 1 that you succeed. If you hand me a gun with 1,000 chambers, 1,000,000 chambers in it, and there's a bullet in one chamber, and you said, put it up your temple, how much do you want to be paid to pull it once? I'm not going to pull it. You know, you can name any sum you want, but it doesn't do anything for me on the upside, and I think the downside's fairly clear. So I'm not interested in that kind of a game, and yet people do it financially and without thinking about it very much.